Welcome to TradeTheNBI.com. This is John's reports for the 11th of June. We got, a new break into the highs, still modest because, again, we don't have enough new data to promote anything. Of course, there was continuation of the situations in Los Angeles. That's not really as relevant. There was a sort of discussion about some type of breakthrough with the Chinese in negotiations where they agreed to framework. That's real. That's progress right there. Agreed to a framework. So no, that's not going very quickly at all. But the market considered that decent. But we're still on hold. But everything from a shakeout, all that. I mean, at this particular point, what is your alternative? You can go into treasuries at this particular yield, but of course, everyone's still buying into the narrative of inflation. And that's what the Fed's on hold, despite all the data that they're getting that it's not materializing. They're still watching the oil situation, and so are we, because it's starting to move in the wrong direction. And that whole drill baby drill is not coming to fruition, at least not driving price anywhere near what is needed. The NQ being stronger is obviously leading the pack on this, and it's enough to just continue to push towards relative new highs, getting close to the Nasdaq's peak. Same with the ES. So it's a slow trog, and it's always going to be more difficult. There's more potential risk to the downside if something should go haywire. And so that's definitely a playing aspect within the broader market at this particular stage. From a treasury standpoint, you got no activity at all. Nothing happened. The Fed just not cooperating at all in this particular case. So oil, this is where it's ugly. And it may not seem bad relative to what we experienced before, but it's still an extreme to where things should be, given what was supposed to be a push towards energy production in that. And, some people blame it on AI and electricity and this and that. But at the end of the day, you just don't have the facilities to produce the distillates that you need across the broad spectrum of the economy, and there just isn't enough worldwide. So whatever disruptions that are taking place there, you're not getting enough volume, because if you had the volume, then price would be dropping, and you don't. So now, on the reverse side, that could indicate that you have broader economic growth, but you're not seeing that development in big numbers. Of course, you're going to have to compare the GDP situation, because the old GDP, where they were considering government spending as part of GDP, well, if you cut the government spending, it's going to look like you're taking a hit on GDP. But if you hold steady within that government spending drop, then, well, you've actually had a huge improvement and a shift towards productive labor of gross domestic product rather than inefficient. And this is something that they added it into for their Keynesian desires, because they had to somehow justify that government spending somehow could help. And it's not. It's a negative drain, always has been, always will be. But it sounded politically better to say that you're getting growth from government spending, which has never been efficient ever. We can see from a euro standpoint, they're still holding on, despite the fact they're in actually worse shape than they've been in a while, but they're holding up because of the expectation that the U.S. is going to implode. And that's really a strange bet that they have. The Europeans are talking about spending every penny they've got to try and save themselves from having to speak Russian because of the impending invasion that's coming in the next couple of years. And they're sort of talking 500-600% increases in defense spending and drones, everything else. But it's just a strange thing overall. But it's one of those elements that the U.S., even though they're still spending even more for defense, is going to have to do less. So why the U.S. needs to be spending that much either, it's also a question mark. From a gold standpoint, again, that potential inflation push, and again, of course, the closer you get to the big beautiful bill and higher spending, it's a tough one, because within it are some significant tax cuts and extensions from ones that already existed. Without it, you have an extra tax burden added on to things because of the expirations of a lot of items, but. Will it move forward? Will there be any reasonable time frame? In which case it does, is it going to get adjusted? A lot of these things are still way up in the air. And if it doesn't happen, then it's probably you're going to end up with 2 years of no significant legislation coming from a Trump administration. So keep that one in mind. Bitcoin, I'm getting closer to its peak levels there, but trading just fine as far as still outpacing the market as a secondary one, and even now outpacing gold. You can see ETH catching up to it, already breaking into relative new high in that range. Not the same, because when you think about it from Bitcoin standpoint, already over here from last December's peak of ETH, already Bitcoin has passed it. So it gives you that pretty significant difference between the two as far as relative strength. And you can see from the intraday, it's still complicated. And this is what I was talking about, that choppy action, but the bias was still to the upside, and that's exactly what proved to be correct. Even looking at the 50K right now, just a brief bit of softness right there. It's going to take some more short activity for that to spike, but here on DOC spread at this particular stage, and if you don't see orange dipping down below, that's not going to be sustainable. But that's just the working out of the options trade, and this is where you can see that intraday activity really matters. Here's the 5 minutes, so you're getting a bunch of call buyers come in, they wipe them out in the GAM and everything, and some flip to puts, and then you short cover those and rinse and repeat, and you just keep doing that back and forth, and that's enough for them to get on the right side of the book for the week, and that's all that matters to them, is holding on through it. And in this particular case, you can see in the European session, pretty negative overall. It's just coming back up to about its halfway point from the original spike dip there, and should continue to ebb higher, fairly decent. There's nothing major happening from a geopolitical standpoint. The war is still continuing in Ukraine, and there's no real effort to see that change. But the Ukrainians are losing at a faster rate than they have been before. So there's going to be a tipping point at which it becomes just a rout, and I think you're probably getting close to that within the next few months. As that shift happens, and then they're forced to actually make a deal, then you could see some kind of reconciliation, which from a global trade standpoint would make a huge difference for everyone, because you'd be able to get back to a more normalized global trade scenario. So that's the long and the short of it for now. Anything relevant, I'll put it on the team chat. Have a good one. Trade well.